Well, Dame Ann Richards joins us now. Thank you so much for being with us today, especially on a pretty big news day where the market is trying to find a direction, looking at the minutes, looking at some of these huge shifts, which is sending commodities lower. And what's the biggest risk to the financial markets right now?
We're in uncharted territory in general. We've got the biggest fiscal taps opening that we've had in decades, at the same time as we're in still completely new territory with monetary policy, because we've had QE at such scale and for so long now. So that I think the biggest risk for markets is simply we're learning as we go in terms of what the policy responses are going to affect and actually create in markets. And this economic cycle has been almost like an economic cycle on speed. We had that dramatic plunge in activity last year. We've seen the most dramatic acceleration of growth after that. We've seen inflation accelerate in a way that we've not seen again for many, many years. And now we're possibly starting to see a slowdown in that acceleration. So it feels like everything has been happening at lightning speed. We've gone through an entire economic cycle, it feels like, in the space of a few months. So I think the risk for markets is really that we are playing in a space that is very different to anything we've played in for many, many years, if at all.
Which means, and that actually we could see huge mistakes. Are we underestimating liquidity? Is there something out there that actually makes you worry about the functioning of the markets?
No, I think if you think back to sort of 15, 16 months ago, that liquidity was a real concern, and the actions of the central banks globally, very much led by the US and Europe, but to ensure that the liquidity in the system was there, I think have taken away the liquidity fear as the primary fear that markets have in that sense. I think the issue today is whether the policy responses that policymakers are going to have to make, and it's a very difficult and fine balancing act, that they make a misstep on that. But if they make a misstep, I think they are likely to tighten too late rather than too early, just because we're still in an unknown territory with the pandemic, with what happened. We've got Delta accelerating, obviously, but what else happens? Could they see it be another mutation? So I think if there's a risk of a policy mistake, it's probably that they leave it too long to tighten rather than that they tighten too soon. But as I say, I think it's just the pace and the speed with which things have been developing that just make it a challenge for people to make some very tough decisions, if you're sitting in that policy seat.
But is that also the pace of technology? I mean, if you look at the pace of change, you're right that it's incredible, actually, what we've lived through in the last 18 months. What will be actually the legacy of this pandemic?
It's the acceleration of technological change. I think that's totally right. I mean, you were mentioning a moment ago about Robinhood and crypto trading. I mean, the crypto assets have accelerated not as a consequence of the pandemic, but nonetheless have been facilitated by the move to the virtual world that everybody has participated in, or at least many, many people have participated in as a consequence of the pandemic. And crypto assets in aggregate are something like $2 trillion now. I mean, it's a massive, massive sum of money there. But on top of that, as a consequence of that move to the virtual world, when we talk about the transmission mechanisms that underpin the financial system, if you think in terms of wavelength, if you think in terms of frequency, you can see that, again, that acceleration has come through, so that the way that central banks are thinking about digital currencies, they don't have time to design the perfect digital central bank currency because of the pace at which technological change has meant that the world outside the central bank world has just moved so very rapidly. And that has consequences because of how banks have been set up. And so the choices that central banks are going to have to make about taking digital transactions and actually thinking about what that means for a digital currency, if there should be a central bank controlled digital currency at all, they're big, hefty decisions that will have very direct consequences on the shape of the banking system, and in fact the shape of the way that you and I interact with the financial system, over the years ahead. And this acceleration, this pace, has been something that is again, we're in uncharted territory.
So, and what does it mean for Fidelity International in terms of how you look at crypto and how you want to get involved in that space?
So we run with various different pilot projects at any moment in time on any kind of new technology that is evolving, and different parts of the Fidelity world are involved in different ways. We have a business in the US which looks at crypto custody, for example, because crypto asset custody, how do you keep that safe? That's been a very important part of actually how what was a sideline becomes more mainstream. It's the key part of making that safe. For us, when we think about portfolios and we think about asset allocation, I think in general our clients are looking at crypto and looking at it cautiously rather than rushing headlong into saying we want to do X, Y, or Z. But we are starting to do modeling and looking at the impact in portfolios. If you have crypto asset, what are the implications of that? How does a crypto asset, for example, how does that behave versus gold in a portfolio? So I think we're still at the early days for kind of mainstream investors thinking about how to pull these things together. But those are the sort of things that we talk about internally.
And how much did Fidelity actually change their stance on China because of the regulatory crackdown we saw over the last couple of weeks?
Well, it's been ongoing for more than the last couple of weeks. It's become, particularly in the education sector more recently, that's been a thing. But obviously, in the technology sector, it started earlier. And I think this is partly an example of where, if you stand back and look at the shape of what's going on in China in general, it believes that there are certain very important parts of the economy, in education, in health, there would be classic examples, where it has realized there needs to be more robust, more comprehensive regulation. And that is something that actually every developed market comes to. And I think China is going through that. Now, sometimes the implementation of that is a bit clunky. It's not necessarily as well managed as it might be in certain places. But the big trend is an improving regulatory environment, which actually ultimately will be better for business.
I think this month, actually, China allowed Fidelity International to launch a fund management business there. I mean, are you comfortable, about the risks surrounding some of the regulatory things that we were just talking about?
Well, look, I think, in every country that we are in, there are different regulatory pressures, and you see them in China, but you see them in every other country that we operate in, and we just we accept and we adapt to whatever the regulatory environment brings to us. But we've been in China for many years. This isn't new. The thing that is, in fact, I think we were the first wholly foreign-owned company to be given a private mutual fund license. So this builds on the presence that we already have there. And we've found that as long as you are transparent with the regulators and you work with the regulators to understand their concerns, we've found that has been a productive relationship and a constructive relationship, and we anticipate that will continue.